September 1929. A Manhattan businessman sensed something was off. Stock prices had been climbing for years, but he could feel the cracks forming beneath the surface of prosperity. One Tuesday morning, acting on pure instinct, he walked into his bank, presented his passbook, and withdrew every single dollar he owned, $12,000 in cash. Just 2 days later, the markets collapsed. Banks across the country failed as panicked depositors lined up outside locked doors. But he was safe. He had his money. Now, let's fast forward to today. Imagine a similar situation. You sense uncertainty in the air and want to protect your family. You log into your 401k and see a healthy balance of $180,000 saved over 20 long years of hard work. You click withdraw, but what happens next is not what you expect. A penalty calculator pops up. It shows you the steep price for taking your own money out early. First, there's federal tax, then state tax. And on top of that, a 10% early withdrawal penalty for anyone under the age of 59 and a half. Before you ever see a cent, back in 1929, wealth was immediate and tangible. Today, our financial system is built with time delays, penalty structures, and regulatory hurdles that simply didn't exist back then. Let me walk you through how this all evolved and what it really means for your financial future. In 1929, your savings account was incredibly straightforward. You'd walk into your local bank, hand over your passbook, and request your balance. The teller would simply count out the cash from the drawer. Same-day withdrawals were standard. There were no processing periods or approval workflows. Owning stocks was just as direct. When you bought shares, you received physical paper certificates that you could actually hold in your hand. To sell, you'd hand over the certificate and get your payment, or sell through a broker with a predictable 3-day settlement. Investors who sensed trouble brewing in September 1929 had immediate options. They could liquidate their investments, converting them to cash, withdraw from banks, and move into cash or gold. The main challenge wasn't systemic restrictions. It was that most people just didn't see the warning signs until it was far too late. When banks failed, they didn't freeze accounts beforehand. They literally ran out of physical money because too many people tried to withdraw at once. This is where modern banking regulations come in. After the Great Depression, financial reforms were designed with one specific goal: to prevent the kind of rapid mass withdrawals that could destabilize the entire system. The intention was to create stability and protect the broader economy. And in many ways, these reforms have worked. We haven't seen bank runs on the scale of the 1930s since, but these protections came with trade-offs. Trade-offs that many of us don't fully understand when we're planning for retirement. Take the 401k, for example. It was created in 1978 and introduced as a fantastic tax advantage. And it is. You don't pay taxes on your contributions right away, which helps your money grow faster. But it also means that today, over $7 trillion in American retirement savings sits in accounts with heavily restricted access. As we talked about, taking money out early can cost you between 35 to 45% in combined penalties and taxes if you're under 59 and a half. So, while the system is safer from a total collapse, your individual access to your own money has become more complicated and costly. The very mechanisms designed to protect the system can feel like they're working against you when you need your money the most. Understanding this trade-off is the first step to truly taking control of your financial planning. What are your thoughts on this evolution? We often think the money in our accounts is just a click away, but the reality is a bit more complicated, especially during stressful times. Let's start with your 401k. Beyond the penalties for early withdrawal, there's the time factor. When you request a withdrawal, plan administrators usually take about 7 to 10 business days to process it, but it can get slower. During the 2008 financial crisis, some major providers actually delayed withdrawal requests for several weeks, calling it an administrative review. Now, what about the cash in your bank? Accessing it has its own rules. If you try to withdraw $10,000 or more in cash, your bank is required to file a report with the Financial Crimes Enforcement Network, or FinCEN. While this is mainly to track illegal activities, banks can also delay large withdrawals if they find your request unusual. And don't forget daily ATM limits, which are typically capped around $500 to $1,000. So even if you have $50,000 in your checking account, getting it all out in physical cash could take weeks of separate trips to the ATM. Investment accounts have their own unique characteristics. Your ability to sell investments hinges on something called liquidity. Think of it like selling a house. In a hot market, buyers are everywhere. In a cold market, they vanish, and you might have to slash your price to make a sale. The same thing happens with stocks and funds. In March 2020, for example, over 200 exchange-traded funds, or ETFs, were trading at discounts of 10 to 20% below the actual value of what they held. This meant your $100,000 ETF might only fetch $80,000, not because the investments inside dropped that much, but simply because buyers became scarce and the market's plumbing was under strain. Even mutual funds have guardrails. SEC rules allow them to hold up to 15% of their assets in illiquid investments, things that can't be sold quickly. If a fund's redemptions spike and it crosses certain thresholds, it can temporarily suspend redemptions altogether. This means you literally cannot sell your shares for a period of time. It's not just a theory. The Woodford Fund in the UK did this back in 2019, freezing investor money for over 3 years. When people finally got their money back, they received about 70 cents for every dollar they had originally invested. These aren't doomsday scenarios. They are actual regulatory mechanisms built into our financial system. They're designed to kick in during periods of extreme stress to prevent a complete collapse and maintain broader stability. Now, why is this so important to understand today? Some financial observers believe these structures could become very relevant given current market conditions. Let's look back at 1929. A key factor in that crash was leverage. Investors would put down just 10% of their own money and borrow the other 90%. A small drop in the market could wipe them out completely. But while regulations have changed, leverage hasn't disappeared. It's just become less visible to the average person. It now exists in complex instruments like derivatives, where the effective leverage can be 20 to 1 or even higher. If these highly leveraged positions were forced to unwind, it could happen much faster than in 1929 because of technology. Today, around 70% of all market trading is done by computer algorithms executing millions of trades per second. These programs are often designed to automatically sell when certain price levels are hit, which can create a domino effect and dramatically amplify a downturn. We got a glimpse of this in March 2020. The S&P 500 fell 34% in just 23 days, the fastest bear market decline in history. Market-wide circuit breakers, which are automatic trading pauses, kicked in multiple times. These are meant to give everyone a moment to breathe and reassess. However, some analysts noted that these pauses sometimes had the opposite effect, compressing all the selling pressure into a shorter window right after trading resumed, leading to even more volatility. Understanding these dynamics is key to navigating the modern financial landscape. Here's a thought experiment for you. Imagine the market gets really volatile and your 401k drops 30% in just 2 weeks. You get nervous and decide to pull your money out, even with the penalties, but it takes 7 to 10 days for that request to process. During that time, the market falls another 20%. By the time you get your money, you've lost half your value. Then you pay about 40% in taxes and penalties on what's left. Suddenly, your $200,000 account is only worth about $60,000 in your pocket. This scenario assumes everything processes normally. In extreme market stress, plan administrators can actually hit pause on withdrawals altogether, using what are called extraordinary circumstances clauses. It's a legal provision that lets them freeze things while they figure out what's going on. It's not just retirement accounts. Our modern banking system runs on digital rails like Fedwire and ACH. These systems are incredibly efficient, but they do have capacity limits. Think back to Silicon Valley Bank in March 2023. The trouble started on a Thursday afternoon. By Friday evening, regulators had stepped in. Anyone with more than the $250,000 FDIC insurance limit could not access their extra funds for several days. Our entire banking system has about $10.5 trillion in deposits, protected by an FDIC insurance fund of around $125 billion. It's designed to handle a few banks failing, but a widespread event could test its limits. Okay, take a breath. I know this sounds intense. The point isn't to cause panic. It's about understanding the real-world mechanics of the financial system we all use. So, what are some professionals and big players doing right now? According to public SEC filings, corporate insiders, executives at major companies, sold $16.2 billion of their own company stock in the last quarter of 2024. That's about 4 times the normal rate. When people with the deepest knowledge of a company start selling, some investors take notice. Even massive sovereign wealth funds are making adjustments. Norway's government pension fund, one of the largest investors in the world, cut its stock holdings by 18% in 2024. These are institutions that plan for decades, not days, so a move like that is significant. We're also seeing some stress in the U.S. Treasury market, which is supposed to be the safest place on earth. The gap between what buyers are willing to pay and what sellers are asking for has widened. When this bid-ask spread gets bigger, it means it's harder to buy and sell easily. Historically, that can be a warning sign of more volatility ahead. Then there are the classic indicators. The Shiller PE ratio, which measures stock valuations against long-term earnings, is at 39. For perspective, it was at 32 just before the 1929 crash and the dot-com bubble. High valuations don't predict a crash, but they suggest the market is priced for perfection. We've also had an inverted yield curve for over 3 years now, where short-term interest rates are higher than long-term ones. Historically, this has been a very reliable predictor of a recession. So, what can you do with this information? First, read the fine print on your accounts. Understand the withdrawal rules, timelines, and penalties. Most people don't look at this until it's an emergency. Second, think about having genuinely accessible cash reserves, 3 to 6 months of expenses in an account you can physically get money from within a day or two. Third, understand what liquidity really means. Seeing a number on a screen is not the same as having cash in your hand. Money market funds, ETFs, even checking accounts all rely on the system working smoothly. Finally, you can look up what corporate insiders are doing with their own money through public SEC filings. It can be very revealing. This isn't about timing the market. It's about understanding the structure of our financial world and making informed choices. A businessman in 1929 who saw the signs could walk into his bank and walk out with his cash. Our system is different. You can't do that anymore. But you can still prepare by understanding the rules, building real reserves, and recognizing the patterns. The choice, as always, is yours. Thanks for watching.